Is borrowing money from Cash App a good idea? For some, it sounds appealing, but it could mean overpaying in the end. Here are 4 things that you need to know. For starters, while Cash App doesn't have a traditional interest structure, it's still not free money. This feature allows eligible users to borrow small amounts of money with a flat fee of 5% and a standard 4-week repayment schedule. So if you borrowed the maximum of $500, you would pay a $25 fee at the 5% rate, payable in 4 weekly installments of $131.25 or a lump sum payment of $525 at the end of the term. Now, paying $25 to borrow $500 might sound reasonable, but here's the reality. When you consider the APR equivalent here, Cash App Borrow actually isn't too cheap. When you borrow money, whether through a personal loan, a credit card, or something else like that, the APR, or annual percentage rate, is the price of borrowing. According to our research at NerdWallet, the average credit card APR was 21.52% as of February 2026, and the average personal loan APR for consumers with good credit was a little over 19%. Here's where things get surprising. Borrowing $500 for a month for $25 might sound cheap, but if you did this every single month for a year, that would translate to an APR equivalent of 60%. Now, this doesn't mean that every single Cash App borrower user is going to pay the equivalent of a 60% APR. Short-term loans with flat fees are calculated differently depending on the exact loan terms and repayment schedule. And unlike typical credit card interest, the 5% Cash App borrow fee is non-compounding. So while most users won't borrow every single month, the broader point here still stands. Even if the fee is non-compounding, the short-term borrowing cost can still be much more expensive than it feels. The next thing to be aware of is that Cash App Borrow is not available to every user, and eligibility is determined by Cash App. Now, according to Cash App, most people become eligible by depositing $300 or more in paychecks monthly, or by linking an external account that receives $500 or more in monthly deposits. But the key word here is most, not all. And even if you do meet those requirements, you still may not qualify. Now, you can do a few things to improve those chances, like spend $500 or more per month through Cash App, maintain a positive account balance, and link an external bank account. But at the end of the day, access is completely at Cash App's discretion. The last thing to know about Cash App Borrow is what exactly happens if your loan becomes overdue. After 3 or more calendar days past your due date, Cash App may use funds you received to your Cash App balance towards what you owe, including money sent to you and certain direct deposits. In addition, a one-time $5 outstanding balance fee may apply here as well, depending on what payment schedule you chose during the application process. And after 7 days, a 1.25% non-compounding weekly interest fee begins. So with all of that said, guys, here are my thoughts on Cash App Borrow. If you qualify, this could be a reasonable option for a short-term pinch. Maybe it's an unexpected car repair, a dental visit, something you just didn't see coming. But if you start using it on a recurring basis, you should pay attention to the potential APR equivalent of this flat fee structure. A flat fee that feels small can add up fast when it becomes a habit. But ultimately, I would love to hear from you. Have you ever used Cash App Borrow or another short-term loan provider? Let me know down in the comments, and make sure you subscribe while you're at it. Thanks for watching, and if you want to keep going, here's another video you might enjoy. I'll see you next time.